Okay, now we get into chapter 10. This is all about corporate bonds. We've heard of corporations offering stock. We're going to cover that actually, I think, in chapter 11. But first, what a lot of corporations do to manage their business is they got to raise money. If you want to launch a new factory or a new product line, or you want to just branch out and expand your business to a new continent across the globe, you need money. So companies can do one of two primary things. They can issue stock, which they're giving up ownership or equity of the company, or they can issue debt. So the equity market is generally the stock market. The debt market is typically bonds. Okay, so what happens when you issue debt is that it's called corporate paper because the corporation is really just writing a paper saying, we'll pay you back. It's a promissory note. Investors give the company money, and the company takes the money out and hopefully invests it wisely in that new factory or the new product line or whatever they're going to do. So basically, bonds are just you're going out for financing, and this is one way to do it. All right, they're interest-bearing notes, obviously, different than the stock market. There's no interest in the stock market. You hope the market goes up if you're an investor, and if it goes down, you lose money. If it goes up and you sell at the right time, you make money. Bonds, it's not that they don't change in value, but they're far less volatile in value. They can be traded like stocks, but typically, we're going to talk about bonds as if you were the investor and you held onto the bond all the way to maturity. Okay, so bonds are interest-bearing notes. They require periodic payments. These payments are every 6 months or semi-annually, unless stated otherwise. That's what the asterisk is for. The interest rate is almost always fixed. We're going to only deal with fixed interest rates here, and that is an annual interest rate, even though these payments are semi-annual. Be aware of that difference. Okay. Face value is the par value of the bonds or the principal that's paid back in full at the maturity date. So what this means is that if you invest $10,000 in a bond, okay, and suppose it was 5% interest, okay, 5% interest of that $10,000 bond, let's see, 10% would be 1,000, so 5% is 500, okay, you would make $500 a year, but it's semi-annually, so it'd be $250 every 6 months, and you get $250 every 6 months, and then at the end of the term of the bond, whether it was 5 years, 10 years, whatever, you would get your $10,000 back. Okay, so you get pretty much guaranteed interest, and you get your principal back. They're much, much safer investing in bonds than it is in the stock market. Stock market is unpredictable, so something to consider. All right. There are several types of bonds. Secured bonds have company assets as collateral. Okay, some bonds don't have that. Okay, you don't have any rights to the company assets. However, in most cases, bonds are secured, and if the company were to be dissolved, okay, debt holders come first in line to company assets before equity holders do. So if the company were to be liquidated, you could get some of your money back for a bond. You probably won't get dollar for dollar. There'll probably be some number of pennies on the dollar. But stock market people hold stock in the company. They don't get anything until all the bond holders have been paid off. Okay, unsecured bonds called debentures are backed only by the credit rating. You hope it's a strong credit rating, and this credit rating affects very much the rates at which bonds are bought and sold and the rates at which they're paid. Okay, convertible bonds can be switched to equity later. In other words, you can swap them out for stock. Okay, callable bonds means the issuer, the company, can retire the bonds before maturity date at a predetermined payoff amount. In other words, they can go, yeah, you know what, it's a 10-year bond, but we got where we wanted to in 7 years. We're just going to call them. In other words, they'll pay them off, and you no longer get the interest payment you were thinking of. They can just pay it off early. Zero coupon bonds where we repay only the principal, and we're not going to talk about those much. Okay, so pros and cons of bonds. First of all, a company can increase its return on equity if it earns a higher higher rate than the fixed percent on the bond. Let me explain what that means, right? If you issued equity, then you're diluting the ownership of the company. So if you issued bonds, you might be increasing the debt ratio of the company, but you're not changing the amount of ownership. That's critical because bonds don't affect the owner control because bondholders don't have actual ownership of the voting rights. Stockholders do. Now, unless you own a large chunk of stock in a company, you may not have that much control of the company, but you do get a vote. You get a vote on the board of directors, you get a vote on the CEO, and you get to speak up at shareholder meetings. How effective that is probably depends on how many shares of stock you own. The interest paid out by the bond issuer, the company, is tax deductible. So even though they're paying out that interest, they get a huge tax break from what's called the debt service. Debt service is just a fancy way of saying interest payments to lenders or investors. The cons for a company mean it can actually decrease return on equity if the company underperforms. In other words, if we sent out the bond at 7% interest, and then whatever product line or whatever the company was doing with the money, if we earned less than 7% interest on our business venture, well, clearly we're not covering the interest we're paying on the bond. If we send out the bond at 7% interest and then we go off and start a new product line somewhere, and that product line proves to have a 20% return, well, clearly that was a great deal. It cost us 7% to go get the money from investors, and we took the money and we ended up doing a business venture or part of our company that went out and made 25% or 20%. Obviously, that's a win for the company. Okay. If the business venture underperforms, if the business venture underperforms, then that it could decrease the return on equity. All right, if the company struggles, the bonds require two things to be paid back. You still got to pay the interest, and you have to pay back the face value, the original capital, the original principal that the investor gave to you. In an IPO, just ask anyone who went through the Facebook IPO. You can go and buy at whatever price the initial public offering was for the stock. Sorry, that's what IPO stands for. But if you went off and gave $40 a share to Facebook, and now it's less than half that, I believe, Facebook doesn't owe you anything. That stock price could drop all the way down to zero, and the company doesn't have to pay you back anything. So the difference between bonds and stocks is you are supposed to get your money back. If the company's liquidated, that might be different, but with a bond, you get your money back. If a company's going belly up and the stock price shoots to zero, they don't owe you anything. The stock you hold in that company becomes nothing but a worthless piece of paper. All right, some financial aspects of bonds. The company goes and gets money from the buyers of the bonds. That money paid depends on the interest rate, the payment schedule, and the market rate of comparable bonds from similar companies or companies with similar ratings. Okay, terminology here. Market rate is what's called the effective rate. That's the rate at which bonds are selling on the open market. The coupon rate is the one that's written actually on the bond itself. The market fluctuates every day. So what IBM bonds might be going for today might be 5.5%. Well, tomorrow morning it might jump up to 5.75. And even little differences like that make a huge difference in the financial markets. So anyone who's bought a home and looked at your interest rate on your mortgage, those tiny interest rate fluctuations can mean tens of thousands of dollars or hundreds of thousands of dollars over the 30-year life of a typical mortgage loan. The coupon rate's written right on the bond. That's fixed, okay? And that's the rate they're going to pay until the bond matures. If the company issues a bond at 8%, that's what they're going to pay investors, and the market changes and all the bonds are getting is 4%, tough luck. The company has signed up to pay that. They're going to pay it the whole life of the bond, okay? If the rate we have on our bond is 8% and the market was 4%, like I said, man, we're offering a great deal. If investors can only get 4% out of the market and our bond says 8%, well, we better sell it at a premium. What that means is if it was a $100,000 bond, we'd actually sell it for more than $100,000, even though we're only going to pay back $100,000 when the bond matures 10 or 15 or 20 or 30 years down the road. If we're offering 8% on our bond, the coupon rate, the contract rate, that's what we're going to pay our investors. And suddenly the market rates shoot up to where the market rates are 9%. Well, why would anyone buy our bonds at 8% when they can go invest somewhere else at 9%? Therefore, in this situation, letter D, we would have to sell our bond at a discount. What that means is we would accept, say, $95,000 or so for a $100,000 bond issue. And what it means is we'd still pay our 8%. People would forego what they could get on the market at 9%. We would accept a slightly lesser dollar than the principal set on paper. And at the end of that bond, if we collected $95,000 for a $100,000 bond issuance, we would still pay them back $100,000. Okay, it was a discount so that we could pay a lower coupon rate than what people could get on the open market. All right, if our rate is the same as the market rate, the bond sells at what's called face value. Okay, $100,000 bond, we would collect 100,000. That's the simplest case. We're going to start with that first, and then go on to cover premiums and discounts. Okay, we'll come back to that in just a second.